Hey everyone, welcome back to Corporate Decoder, the place where we untangle the confusing language of big business. And sometimes we uncover some really interesting stuff, or maybe some really silly stuff. Let's dive in. You probably know John Hancock as that name on insurance policies, or maybe you've seen their investment funds advertised. Today we're diving into their latest Shareholder DARB report for the year ending the 31st of October 2025. And let me tell you, there is quite a story here, especially if you care about your money and how it is being handled. This isn't just a dry document for accountants. It is a look under the hood of how these massive funds are performing and where your investments stand. Now let's talk about one of their funds, the ESG Large Cap Core Fund. It sounds fancy, right? ESG stands for Environmental, Social and Governance. And basically it means they're trying to invest in companies that are not only profitable, but also good for the planet and society. But how did it actually do? For a hypothetical $10,000 investment in the class, a shares this fund cost you about $117 for the year. That is 1.11% of your investment going to fees. For Class C shares, that number jumps to $196 or 1.86%. So right off the bat, you see those fees can eat into your returns. The report says this fund returned 11.17% excluding sales charges. That is after all the fund running costs. They mention a rebound in US large cap stocks driven by good earnings and investor optimism. Makes sense, right? Companies made money, investors felt good, and the market went up. They're giving a shout out to information technology stocks like Nvidia Corporation and Microsoft Corporation. Apparently the AI boom is still fueling these companies. Nvidia is still the backbone for AI systems, and Microsoft is embedding AI into its cloud services. That is a pretty neat explanation. Communication services also did well, with companies like Alphabet Incorporated, formerly known as Google, benefiting from advertising and their AI work. Netflix Incorporated is also mentioned for subscriber growth and better pricing, but it wasn't all sunshine. The report highlights the healthcare sector as a drag. Why? Well, political pressures to lower drug prices and regulatory uncertainty are weighing them down. Companies like United Health Group Incorporated are struggling with higher costs, and even big names like Novo Nordisk Gas face competition and questions about their blockbuster drugs. The materials sector also took a hit. Think of companies providing everyday stuff like Avery Dennison Corporation. They face pressure from weaker demand and economic uncertainties. Let's look at the numbers. The fund holds about $122.4 million worth of assets. That sounds like a lot, but it is spread across 66 different holdings. They paid out nearly $500,000 in advisory fees. That is a chunk of change. Portfolio turnover rate is 18%, which means they buy and sell about a fifth of their holdings each year. Not a lot of churn, which can be good. And who are they betting on the most? Nvidia Corporation at almost 10% of the entire fund. That is a big bet on one company. Microsoft Corporation is next at 8% and Apple Incorporated at 6.4%. The top 10 holdings make up a significant portion of the fund. Unsurprisingly, information technology is their biggest sector bet at over 36%. They're heavily invested in tech. Financials come in second at over 12%, followed by industrials at over 10%. But notice healthcare is over 8% and materials is over 3%. These were the sectors they mentioned as detractors. Interesting, they still hold them. Now here is a significant update. Starting in mid-2025, the board decided to recommend reorganizing this fund into another one called John Hancock Fundamental Large Cap Core Fund. Shareholders voted yes, and this change is expected to happen around January 2026. This often means the fund gets absorbed and its strategy might shift a bit. Let's switch gears to the John Hancock Global Environmental Opportunities Fund. This one sounds even more specific in its ESG focus. For Class A shares, the cost was about $125 on a $10,000 investment. That is 1.21%. Class C shares cost more at $202 or 1.96%. Higher fees here too. This fund returned 7.03% excluding sales charges. They cite strong global equity gains, especially in the US, driven by easing inflation, tech earnings, and AI optimism. Growth stocks, especially in tech, outperformed value stocks here too. They're highlighting energy efficiency as a big contributor. Think semiconductor companies tied to AI spending like ASML holding NV Siemens, AGI, and Taiwan Semiconductor Manufacturing Company Limited. Building efficiency companies like Legrand Sa and Train Technologies PLC also did well. Renewable energy saw electrical companies like Ternariti Electrica Nazionale and Quanta Services Incorporated benefiting from solar demand and grid investments. And the digital economy software side did well too, thanks to easing us China trade tensions, with companies like Cadence Design Systems Incorporated in electronic design automation and Autodesk Incorporated contributing. The big detractor here was sustainable agriculture and forestry. Apparently softer as consumer demand hit companies like Simrise, Aguvod, Saar, and DSM Firmenich, agrinds and flavor suppliers for cosmetics and food industries. And a specific mention of Synopsys Incorporated, a software company that saw a sharp stock price drop after missing expectations and lowering its full-year guidance. This fund manages about $109 million in assets. That is a bit smaller than the ESG fund. They hold 45 companies, not super diversified compared to the other fund. A 56% turnover rate means they buy and sell about half their holdings annually. That is quite a bit of trading, suggesting they are actively managing these environmental themes. Their top holding is Taiwan Semiconductor Manufacturing Company Limited at 3.7%, followed by Schneider Electric SA and Train Technologies PLC. This tells you they are focused on technology and industrial companies for their environmental plays. Industrials make up nearly half of this fund's investments. That is a huge chunk, and it tells you their environmental theme is heavily weighted towards industrial solutions. Information technology is second at over 31%, by the way. Finally, let's look at the John Hancock International Dynamic Growth Fund. This one aims for capital appreciation outside of the US. Class A shares cost about $132 or 1.18% for a $10,000 investment. Class C shares are higher at $216 or 1.93%. So this fund had a really strong year, returning over 24% excluding sales charges. What drove this? Non-US equity markets performed exceptionally well. They mention improving earnings, attractive valuations, the continued build out of generative AI, and a weaker US dollar. All good signs for international investments. They're highlighting Fujikura Limited, a Japanese company benefiting from AI demand for its fiber optic products. Mitsubishi Heavy Industries Limited, a Japanese industrial giant, also did well because data centers need power and they make power generation equipment rolls. Royce Holdings plc, the British aerospace and defence company, also saw robust earnings growth from defence contracts and power generation. But here too there were some stumbles. On holding AG, a German sports apparel maker, declined due to economic uncertainty and competition. LVMH, Moët Hennessy, Louis Vuitton, say a luxury goods maker from France, also reported weaker than expected earnings due to tariffs and slumping demand, leading the fund managers to sell. Teva Pharmaceutical Industries Limited, a drug maker from Israel, also got hit by disappointing revenue forecasts. This is a big fund. It manages over $2.9 billion, huge compared to the others. They hold 48 companies, moderately diversified. And get this, their portfolio turnover rate is 135%. That means they are actively trading, selling, and buying a lot of their holdings over a year. They are on the move. Their top holding is Taiwan Semiconductor Manufacturing Company Limited at almost 7%, followed by Fujikura Limited and Mitsubishi Heavy Industries Limited. Again, technology and industrial companies are front and center. Industrials make up over 32% of the fund. Information technology is second at over 25%. Financials are the third largest at 17%, very different sector focus from the other funds. Now let's zoom out a bit. What is the big picture here? John Hancock is managing a lot of money across different themes. The SG fund is dealing with some sector-specific headwinds like healthcare and materials. The Global Environmental Fund is more focused on industrials and tech for its environmental angle, but also faced a detractor in agriculture. The International Dynamic Growth Fund had a stellar year riding the non-US market wave, primarily through industrials and tech. A major theme across all three analysed is the dominance of information technology stocks, particularly those related to AI. Nvidia and Microsoft are showing up everywhere. This shows where the big money is flowing. What is interesting for investors is the fee structures. Class A and C shares have sales charges that come out of your pocket or reduce your returns, which is standard. But Class I and R6 shares have significantly lower costs and better performance numbers for the same underlying investments. This highlights the importance of choosing the right share class for your investment. It can literally save you thousands over time. We also see a recurring theme of active management with decent turnover rates, especially in the international fund. This suggests the managers are trying to capitalize on market opportunities rather than just passively holding stocks. Looking at the risks, they mention ESG investing risks and industry sector risks. For ESG, it highlights that relying on third-party data can be tricky and processes might have to change as regulations evolve. For sector risks, they point out that concentrating in one area like tech makes you vulnerable if that sector hits a rough patch. The International Dynamic Growth Fund's performance is definitely the standout this year. That 24% return is significant, and they seem to have timed the international markets comeback well. However, their high turnover rate suggests they might be engaging in more speculative trading to achieve that growth. The ESG Large Cap Core Fund's reorganization into the Fundamental Large Cap Core Fund is a big change for investors in that fund. It is important to understand how that transition will affect your investment goals and any potential strategic shifts. They are essentially merging and potentially streamlining their offerings. Overall, these reports give a detailed look at how these specific funds are managed and how they performed. While the ESG and environmental funds have their own unique challenges and strategies, the International Fund really grabbed the spotlight with its strong performance, proving that global diversification, especially in key tech and industrial growth areas, can pay off handsomely when the timing is right. It is a good reminder that not all growth is created equal, and understanding the underlying strategy and costs is paramount. So what is your take on these numbers and what they signal for John Hancock's investment strategies as a whole? Do you think the ESG focus is paying off, or is it overshadowing returns? Let me know your thoughts in the comments below. If this deep dive helped you understand these filings better, hit that like button. It really helps out, and subscribe for more corporate breakdowns just like this. And don't forget to join our Discord community, linked in the description for more exclusive content and discussions. Thanks for watching, and I'll see you on the next Corporate Decoder.